But all right, well, good morning, everybody. It's the start of a new week. It's 7-Eleven, a great convenience store. I'd still argue better than Wawa, but only people in the Northeast know what a Wawa is, I think. But 7-Eleven, I'm joined with my good friends Charlie Peabody, Ben Bry. I'm David, and let's just jump into first on the macro side and everything that we're seeing that with Ben that you're seeing. You saw the Kospi down a lot. You saw an IPO get carried over the line on Friday, but then limit down uh, today. What does that have anything to do with what's going on with the Middle East? Does it have what should we make of those data points? And also, you have the
I
market. You have the
mean,
market up off the bottom, even though the war seems to be restarting.
yeah, I mean, I don't have a great comment on the war part of it, where it's like, I mean, how many times have we had, oh, we got a deal, oh, there's no deal, oh, there's like, at this point, maybe the market's exhausted on it. I do know that I'll tell you this: diesel diesel refiner margins right now are enormous, and spot oil is only in the low 70s. Like, there's something off there. Like, the diesel refiner margins are like $75 or something, like, in oil 70. So there's I know Charlie's bullish energy. I think there's something there. That'd be more the way I would think about if you wanted to trade the war. I think oil's your play there. I don't think stocks are the right thing, but the SK Hynix, they last week on Friday they did a $26 billion or $29 billion, I think it was, ADR, so that they're going to be listed in the U.S. I mean, I don't know. Look, they magically pump up the market in Korea and the U.S. You get like a nice rally, and then on the Korean Open they just start giving it back right away. They took, because I think it went up 15% over the common the close, that so the Koreans Friday market versus the US. And so I think that arbitrageurs come in, and then they took the all that up, and then the Korean market came in and just took it back. Like I said, oh, we'll take that free mark. Thank you very much, new money. Welcome to SK Hynix. But
Yeah, and actually, I mean, one of the things we probably know, the Wall Street Journal ran an article, I think it was over the weekend, but how the AI boom is generating a boom for private jets, that everybody's running out to get their own private jet, or at least share of it. I doubt that's happening in South Korea with all the Hynix money. But when you think about a deal like this, is it emblematic of what's going on with AI, or are they two very separate things?
it's very much what they're going on with AI, right? I mean, those Korea has two stocks that are like 40-50% of the Kospi. And so you have Samsung and SK Hynix. And right now, the way that these transformer LLMs are structured, like just actual, math and how it works, it's a huge context memory hog. And, they're running very inefficiently. Uh, and they're also using all these agent flows now, which, if you're not running it correctly, can be inefficient. And the problem is that memory is the biggest transaction, and when you move data, biggest source of power also. And it just, this is a huge amount of new memory that was not planned for. And again, memory is a bad business. Like, I got involved in Micron in 2016, right around the time David Einhorn did it, like $9, and it was because they were the last guys left. My podcast co-host Rupert likes to laugh that refinanced SK Hynix twice in like 18 months in the around the in the aftermath of the .com. So, they're having their moment the way any miner would, or any commodity business would. They're having super margins right now, and I think that there's an undersupply at least through 2027. But there's two Chinese firms that are come on. They're going to double their capacity. So within 2 years, it should resolve itself. So it's a bit playing like with fire, David. Like you're chasing the dragon and following, but then you're like, okay, every day we get closer to 2028 being the out year earnings, So I think that there's 2028 is probably where these things are really trading on, and I think that clearly some air is coming out because Korea and some of these names are already down 20-25% from the peak.
So
You know,
you mentioned your podcast. What remind everybody where they can find that podcast, but also what was the last posting, last one that you did had to do with the return on investment on AI. What's
Yeah,
what's the nutshell? What's the nutshell of that from the squirrel?
yeah, the show's called Benny and the Squirrel, and we're on YouTube on Thursdays and Sundays. We actually just had Charlie on last week, giving us the preview of banks. The concept is like basically as I looked at this whole concept of enterprise ROI, I was trying to like build an app that would you could download and it would ingest like your Claude or whatever you use and then give you a monitor of like how much you're spending or and try to like start getting like a tool for like kind of the retail slash smaller mom and pop type of side of the market users just because I not myself building something but like once I got into it, I was like, oh my God, the ROI question is so complex that it's not like, you have to, how do you define success if you don't measure it? And like, or, how can you be successful? Like, you have to define your outcomes. You have to define what it is that you really care about. Because if you're using LM for research the way we would, you don't mind failure, right? Like it's not a big deal. You're like, oh, I learned something new. Whereas if you're a lawyer, right, you need to have full accuracy. And if the more repetitions you run of it, even if it's 95 or 99 over enough repetitions, you're going to have this chance of ruin. And I think, David, you heard stories about these people who put legal briefs out printed by LLMs, and then they basically like got disbarred and lost their job and had a lawsuit because it came out that they didn't do it. And so there's this like catastrophic left tail risk that's not embedded. You have like all kinds of factors beyond just what the most obvious, which is cost. And then the other thing is like basically when we think about what's the atomic unit of ROI measurement, it's actually the task. It's not a token. Everyone talks about tokens, but the really is it should be cost per task versus a human baseline. And if you think about a lot of these earnings, and I'm sure Charlie can tell you because the banks are probably the biggest offenders, they're big into the counterfactuals, right? Like, oh, we didn't have to hire this many people. Well, we can't disprove that. You know what I mean? So there's a bunch of the narrative being supported by these counterfactuals, but the reality is most of the data shows that guys don't know how to measure ROI, let alone realize ROI. The people who actually are like a company like XPO Logistics, shipping trucking company, they design their system from the ground up with their data level and their architecture above it or their stack above it, and so it's very 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 well defined, measured, like they're doing well. So but the point is a lot of guys aren't doing that. It takes 6 to 24 months to do a full stack, like, and you got to be able to test it. So I think my big takeaway is basically like there's no chance the whole market is going to get up to speed into what you really have to do to run these things effectively. It's a lot more complex than most people realize, and it'll work itself out. Because if you think about 99, 2000, like those internet sites weren't good, but they eventually, they got. I'm thinking like with the free cash flow of the hyperscalers set to go negative within the next 60 days, 70 days, something like that, and private credit starting to balk a little bit, and they've been the two major drivers of this. I think that there's a disconnect between the technology and the capital markets, and this is going to become every day more and more about the funding of this and the
Yeah, I
capital
mean,
spending.
if I can put it in a nutshell, I think what you're saying, at least for investors who aren't that familiar with this, everyone thinks that people want to run public companies as great businesses, and almost all of them probably do. But a lot of them don't know what running a great business is. If someone's throwing tons of money at you, and we're talking tens of billions of dollars, and you have a good idea, and you're not sure that you can turn it into a business, guess what? You're going to keep trying because someone keeps funding you. If you had a really rich uncle who said, "Sure, try to make your slushy machine a great new product, a hobby that turns into a business," and he keeps funding you to the tune of millions and millions, you're going to keep doing it. And so, what you're saying is that look, these might not be great businesses when they finally get down to the business side of it after they build it and figure it out. What does that mean though for the stocks? Like, what stocks does that make you more cautious on versus less?
I mean, I guess you'd say that everybody who's been the beneficiary of the capex, that's a cyclical, like a Vertiv, you know what I mean, or Powell Holdings, or some of these manufacturing cyclicals, or some of these just bottlenecks within the AI supply chain have gotten really bid up, and if this fire hose slows down and the revenue per you know task, if you will, is declining, you have an issue where the industry has basically had circular funding drive this, and then media and the hype drive it. But like, again, I don't think the enterprise spending is there to support it right now. So the question is like, because these guys are so big, Nvidia funds CoreWeave, which is a neo cloud, and then neo cloud buys Nvidia chips. Like, I get why he does it. They did this in the .com circular funding, but like the risk on this whole thing is there's a disconnect that if this ROI thing really is an issue, that's the most important thing, right? Like because that's who's going to ultimately give you the cash flow to justify the multiples and all this stuff. And maybe it will happen, but I just think in the near term, the what you've seen from our ROI perspective is not there. And I think just even the understanding, like, it's even worse than just the adoption. Like, if everybody knew the exact playbook, like, then that'd be one thing, but it'd still take like a certain amount of time for everyone to implement it correctly. Plus, there's just a lot of middle layer software that needs to be built. I don't know. These things just take time. And I just think that like the market prices don't jive with where we're actually at. And I think that's why you're seeing Google sell $80 billion of stock, SpaceX run out the door. Um, yeah, it's so And also, one last thing, OpenAI seems to be the real bugaboo on it. Like, those guys clearly have lost their lead to Anthropic. It comes out that the frontier labs are having a hard time staying in front of people. Grok comes out of nowhere with a really good model. Chinese models are pretty good. I mean, I think more and more people realize these LLMs are much more akin to a commodity than some sustainable moat. And if we get where OpenAI pushes its IPO back, why'd they do that? Must have done it because the numbers were not that good. Well, these two companies represent half the cloud commitments for the big hyperscalers right now. And then you have Meta come out and say, "Oh, we're going to offer cloud." SpaceX did that. So I think the stocks that I dislike the most are the neo clouds, the ones that don't really need to be there. I think they were supportive of when the market was in its first couple of years and it was tight, and CoreWeave was really smart. Those Magnetar boys are not dumb guys, and they were there with GPUs and that big training boom. And now it's like they're all dependent on the capital markets in order to work, and there's still the uncertainty of what the useful life in those chips. So I just think you look around and you see where's the weakest link that has the most tie to both, like, going both the credit markets and the capex spend, and that's probably your epicenter right there.
Go
David, if
ahead.
I can add my 2 cents on this issue,
Yeah, of course.
uh, from a banking capital markets perspective, but SpaceX is now trading around 137. Its IPO price was 135. Its opening price was like 145 or something like that. So it's trading below its opening trade. I think SK Hynix is getting close to its opening trade, if not below it. So when you get this poor secondary market, it destroys confidence amongst the buy side. And that's important because, going back to what Ben was saying, these hyperscalers are all planning, like Google, to issue more equity to finance, their capex spend. But if you don't get the good secondary market reaction, it destroys confidence, not just amongst the buy side, but also amongst the CEOs. So that I think you have to watch. I mean, my you know expectation is these important levels will be supported because they're so important to Wall Street. But if they can't hold it, that's not good.
Yeah, especially if you think about 6 months from now when some of the lockups start to expire, if you're, I mean, first, if you're up or you're down, there's a good chance that since you've made so much money in the IPO that you're out. But maybe not if you're Ron Barron, but maybe if you're Ron Barron. But if you're down at like 120 and you distribute this to your LPs, what are they going to do? So, you're down. That mental market of where it went public versus to where it is now, you're right, is so important psychologically for a lot of investors. Be interesting to see how much the banks defend it because it's such a large market cap. That's a lot to defend, but banks better than I do. So why don't we switch it over to banks? They're going to be reporting earnings this coming week. What does it look like? Does it look good? Does it look bad? Does it look good, but it really is bad? How should we think about it?
No, it's going to be phenomenal. I mean, bottom line is I expect earnings per share to be up 25, 26% year over year. And that's going to be on 11% growth in revenues year over year. So it's going to be a great, great quarter. The question is, in my mind, is it a peak quarter? And I think it is peak, and that the momentum will decelerate from here into the first half of 27. So, Jen, I don't know if you can put up the first slide, which is the earnings per share expectations. So on the left-hand column, you have my estimates, and then just next to that are the street estimates. I will tell you the street estimates every day keep coming up. So the expectations continue to rise going into tomorrow morning. By the way, tomorrow morning we have 5 of the biggest banks reporting. So there's not going to be any great fundamental analysis. It's all going to be reaction to sound bites and what management say on the calls. So I wouldn't read too much into the fundamental reaction of stock prices tomorrow because we just don't have the time to do real good analysis. But anyway, if you look at these earnings per share estimates, I want to make a couple of observations about individual names. So Bank of America, the street's at $1.13. I'm at $1.12. Recently, estimates have been creeping up to $1.15, $1.16. And the main reason is because Bank of America normally reports the day after JP Morgan. This time, for the first time that I can remember, they're reporting the exact same time as JP Morgan, and they're putting their conference call on at the exact same time as JP Morgan. So I don't know what's up with that, other than maybe Brian Moynihan wants to take over as the industry spokesman from Jamie Dimon. But it has caused people to say, if they're upping their earnings release date by a day, they must have good news because no bank hides, good news. So you got a lot of optimism around Bank of America. The other name, Wells Fargo, people are, talking that name up. Streets at $1.71. Now they're talking $1.75, $1.76. It's probably because they have some great trading or investment banking gains or venture capital gains. So I don't think people will pay up for that. But then the other thing they're expecting on the call is for management to emphasize the pickup in net interest income in the second half of the year and maybe even up their forecast of a $50 billion NII for calendar year 26. So those are the two names that are getting a lot of talk. Everyone expects JP Morgan, Goldman Sachs, Morgan Stanley to report great numbers just because capital markets have been so strong. I guess where I'm, the most different from the street is Citigroup. I'm at 307. The street's at 274. Although I've seen those estimates coming up pretty aggressively recently. And again, in Citigroup's case, I think people are underestimating the momentum they have in net interest income, which is what you want to see. That's a higher multiple earnings than trading gains or venture capital gains. So those are some of the names that I think are being talked about. On the weak side, Truist probably is the one that people are trying to figure out. Management there has failed to deliver on their merger. And so people have been disappointed with that. There was a recent management change at the very top level where the CEO was basically kicked upstairs to the chairman level. And so you got a new CEO who's going to probably spend the next 6 months retooling the bank. So it's probably dead money. But those are some of the highlights that you can expect on the quarter. If you go to the next slide, Jen, this is the revenue expectations. If you look all the way to the right is the year-over-year revenue expectations for the second quarter. So you can see it's roughly 11, maybe 12% increase. That's pretty, spread out. You're talking about high single-digit growth in net interest income, or what we call top-line revenues or spread income, and then mid-teen growth in fee income, which is largely trading and investment banking and wealth management. So it's a pretty robust, across the board revenue. If you go to the next slide, this is just showing some of the fundamental metrics. And the one that I want to focus on is in the middle of the page, PPNR, pre-tax, pre-provision net revenues. And that's basically total revenues minus operating expenses. So no credit costs, just core operating expenses like personnel costs and occupancy and technology. And that on a year over year basis is going to be up 16%. And my studies say PPNR is a coincident indicator and has the most correlation with stock prices. And as PPNR year over year growth peaks, so do stock prices in the banking industry. So that's what we'll see is this is the peak for PPNR, or do we have one more quarter of strong PPNR in the third quarter? I think it is the peak, and I think it'll slow to mid-single digits by the first half of 27. So I'm a seller into the strong bank earnings. And then we go to the last slide, and then I'll end it here. This is deposit costs, and the salmon-colored column is what banks are paying you for your deposits, and you can see it's around 2%, 2.11% on average. So with the 2-year now trading at 4.25, and we'll see what Warsh says this week. That's going to be another major determinant of how bank stocks trade coming out of earnings, is his Humphrey Hawkins testimony. But if he remains hawkish, and we're going to see some pressure on deposit margins, because they're a good 200 basis points below the 2-year. And so we could see, some liquidity drain from the banking system. And that would be very detrimental to the regional banks if that happens. If we get the yield seekers coming back into the market, chasing rates. So to me, that's the biggest risk is what happens to deposit costs.
So when you're thinking about the quarter and the conference calls and what you're listening for, if you're listening for like this is peak earnings, what are the kind of the cues that might be that, okay, this is the language that they use when things are peak? What are the things that you're listening for that kind of point to that?
Well, you would listen at a very broad macro point of view. Is the economy slowing? That because that's going to determine loan demand and liquidity on the deposit side. You're going to want to hear about the comments about the yield curve. If the yield curve is flattening now, I think we're around 35 basis points between 2s and 10s. That would put pressure on margins. So loan growth, yield curve, slowing economy. Those are all going to feed into expectations about net interest income. And then on the capital market side, typically they don't provide a lot of guidance. I mean, way out. Come August or September, they'll provide intra-quarter guidance, but not 2 or 3 quarters out. So what they're going to talk about is the pipeline of deals, and that's robust. The pipeline is big. Is it at record levels? Maybe not, but that's where it was back in March at record levels. So you're going to listen for the pipeline. I think more importantly is going to be what's the backdrop for executing these deals. And that's why I mentioned, the confidence of how these things play out in the secondary market. Because if the secondary market falls apart, then I don't care what the backlog is. You're just not going to be able to execute. And then finally, credit quality, which I'm anticipating will be fairly benign this quarter. But, and I wrote about this on Sunday night, this will be the biggest increase in loan loss reserves that you've seen since the third quarter of 24 in this quarter. And I'm anticipating that they're building their loan loss reserves because loan growth has been so strong. But I am going to be listening very carefully to see if there is any sort of deterioration on the corporate front, because that's where I expect some deterioration to develop over the next 6 months.
Got it. All right. Well, something to really look forward to. Bank earnings. As you know, I own from previous employers a lot of bank stock, so I'll be listening with bated breath, I guess. So I just wanted to mention one stock that I just started to look at. I own a little bit of it. INCY. It's a name that I haven't mentioned before. Insight. It's a very large biotech company. What got me interested in is that I missed it. So it's up 68% or 65% year to date. And this is a really, I mean, it's a big company, but let's look at the kind of the positives and the negatives and where I am so far. Excuse me. So the first quarter they came in, they blew away numbers, $1.81 in EPS, and that's a pretty clean number. Beat consensus, beat everybody else's model, and where everyone's focused is they have this one major product, and that came in at $800 million, $758 million, 7% up year over year. So that's great. The reason everyone's focused on that is that goes off patent in a couple of years. So that's a big product. Out of the 1.3 billion that they reported in revenue, half of it or so came from this one product. Oh, now you understand why people are looking at it. But the portfolio outside of that product was up 63% year over year. They have a whole bunch of new little products. When I say little, one's annualizing at around $500 million. But for big pharma, that's kind of small. So one grew 20%, another grew 116%. So these are small products they're not going to fill the gap, but you have a good business outside of this product that's going to go off patent. They're also ramping up R&D. They have 10 phase 3 programs. That's a big pipeline. Also means you could have a lot of disappointments too, right? So if you're working on a lot of things, you should expect not all of them work. So the 2029 patent expiry horizon is what everyone's focused on. Why has the stock done so well in the face of that? Well, because they're blowing through numbers, they're generating cash, and they have a way that they could get through this. Will they be able to do it without any hiccups? Probably not. It's too big, but they do have a good pipeline. So people are going to give them this next year at least to see how this transitions. And they report on the 28th. If they blow through numbers again, people will say, okay, now we know what they're doing. They can invest in the pipeline and still deliver great numbers. And so like I said, I own a little bit. I want to do more work to see really what this patent expiry means. There are companies that have managed this well, like AbbVie did a few years ago. But there are lots of companies that haven't. So, we'll see. It's a good one to take a look at because it's well covered. It's a large cap name and something that you can do actual work on. So,
David,
I like these things. I like these things that climb the wall of worry, where people are like, "Hey, this is going to fall apart." I like to be fast out of them when they start to fall apart. But what was that, Charlie?
I know this company very well and involved. I don't know how big this product is, but they're big in research on the blood cancers, which I unfortunately suffer from. But they are doing some trials right now, which I'm involved with, on relapse of B-cell lymphoma. And they also have a drug, I think, for Waldenstrom's, which is another blood cancer. How do you know how big those? Because that seems to be where they're really having great strides from the oncologists I work with.
So it's been one of their fastest. Yeah, so I don't know the pipeline, so I can't really answer that because again, I've just started doing work on this. But the hematology oncology portfolio grew 116% this last quarter to $200 million. So they have a couple products, Niktimvo, which is one of the products that's partnered with another company that I own a lot of. So that's one good thing about biopharma. You can play the main company or you can play derivatives, like companies that have overseas rights for them or who were the originators. But but no, that area is growing tremendously, and the pipeline is really what I have to do the work on now.
Well, I understand their drugs in that area are very effective.
And that's the other thing is like a company like this. So they're in healthcare, you can invest in a lot of different areas, right? It's always good when you're investing in things that matter. And first, it makes you feel better, but also people will pay more for you're extending someone's life or you're saving their life. And so now those things also face a lot of innovation risk. For example, if you have a product that extends someone's life by 6 months and something else comes out and it's by 9 months, no one's going to use the 6 month product anymore unless they're already on it, and they might not want to switch. But all things being equal, all side effects being equal, duration of effect and efficacy really matter in oncology and hematology. So you have a little bit of a weird innovation risk that replacement by others can happen very, very quickly. But right now they're doing great. And so I do want to do more work on the. Oh, but what are you talking about? The valuation? It's pretty cheap. It's cheaper than the average large cap biotech company, and the reason is because of this patent expiry. So people worry about that. I have a little chart here, but I'll share that in our notes. All you need to know is I'm starting to look at it. I own a little bit of it, and it's cheap relative to other large cap biotechs, and it's generating cash. So I'm not worried about them running out of money. But with that, everybody, unless anyone has any final comments, let's call it a day. It's Monday. A lot of work ahead of us for the week. For Charlie Peabody, Ben Bry, I'm David Maris. Everybody have a great week. Thanks.
Thanks, guys. Thanks, Jen.